Hi, everyone. Today I'm super excited. We have a very special episode. We do not have one fund manager, but we have two amazing fund managers with us. We have a Black female emerging fund manager who founded ZANE Venture Fund, a seed fund that would invest in underrepresented founders with the goal of closing the funding gap. She recently launched the Pre-Capital Program, a program designed to support underrepresented founders in becoming capital ready. We also have one of the very talented and very well known early stage investor and entrepreneur. He has been investing in the venture capital area since 1987. He has written amazing books, especially Venture Deal, everyone should read. He's also a co-founder of Techstars. He can be called the father of early stage investments. Many people know him for many of his accolades, but I know him as the singer and actor of one of my favorite jam, I'm a VC. Welcome to She VC. I'm your founder and host, Gayatri Sarkar. So today we have Shila Nieves Burney and Brad Feld with us. So super excited to welcome you both.
Thank you so much. It's great to be here.
Thanks. I'm psyched to be here with you.
I hope the introduction was good for Brad, especially I'm a big fan of that video.
I'm a VC, right?
Yes.
I gotta check that out. I haven't seen that. That hasn't come across my radar. I have to go look for it.
You should definitely check that out.
I have zero aptitude for dancing, singing, or playing music, although several of my partners at Foundry, including in that video, two of my four partners, two of the four of us have a lot of aptitude, and one of the four of us thinks he has aptitude, and then there's me. So if you watch the video, I'm a VC, you can decide for yourself who is who.
Okay.
That's amazing. So because we are talking about aptitude and diversity in skills, I would love to ask my first question to Shila. You have talked about diversity as a competitive advantage. Private investing world is built by people who wants to hire, invest in people who look like them and think like them. So tell us more about why you think diversity is a competitive advantage and why you decided to create a program for entrepreneurs from southeastern part of US to have a platform like Zane Access Pre-Capital Program.
Sure. So let's start with the fact that diversity is not just about how you look. While there has been some pattern matching going on, diversity is way beyond how another person looks. Race is a huge part of it, but it's not the only sort of qualifier for diversity. We are talking about many forms of diversity: age, grade, gender, sexuality, lived experience, the immigrant, the LGBTQ, first gen. All of these, in my opinion, provide sort of an advantage in terms of diversity. I'll just speak about us. We're not a homogenous team, right? We can't do this with just my thinking and who I come and represent. I need to have everyone from all different sort of backgrounds to make sure that, we get the right kind of deal that we're looking for. It's going to take people who have all these sort of experiences. And so, I would just answer that, with, I feel like the most competitive teams are those who have thought about diversity and have ensured their teams are diverse, because all of those things, all of those attributes are important to make a good team, and in my opinion, to make a good investment, because there are going to be some investments that will come our way. I won't know anything about it, or it won't maybe have an impact on my sort of life. But someone on our team may be able to speak to that particular deal and share with us why this deal is important because of their sort of background, their lived experience, that sort of thing. So I do believe it's competitive in that.
That's great. I would love to know how you got Brad and what got Brad excited to be a part of this program.
So when I first started in Venture, right, which was 2 years ago, I'm sort of a researcher by nature. I'm going to look for who is the best, what should I be reading, how should I learn about this? And so, of course, Brad's book came up as one of the first. I think it was considered to be the Bible of venture capital.
Yes, absolutely.
Yeah, and so for me, I'm not going to say I'm a Bible reader, but I know what the Bible means to most folks. So I thought this was the book that I needed to sort of, get myself prepared for VC. And so once fund is formed, and we were going to now educate other people about investors, I'm going to share with them what was important to me. And so I, reached out to Brad for books for a cohort, because I feel like if we're going to take them through a 12-week program, we want to make sure they have, access to all these different things that will make them successful. And to me, the venture deals books was one of those. So I reached out to him, and the story is history. He said, yes, of course, and offered some other things, including speaking to our cohort and sponsoring a few of those where finances were a barrier to entry. We didn't want that to happen. So we shared with Brad what was happening with a few of our companies, and he said, I'll take care of all 8 of them. And so, I mean, I shook that whole weekend because I was really surprised, but also thankful and so grateful that, just a simple outreach for books turned into, now what we consider, a family member who's now part of the ZANE community, part of our village that's out here helping underrepresented entrepreneurs.
That's amazing. So Brad, you have been in the venture capital community since 1987. You have seen so many things. So what got you excited to be a part of this particular program?
Well, some of it is something that happens in my world a lot. I'm a big fan of randomness. And I try to always have myself open to any new thing that comes along. A really good classic example of this is Techstars, which literally happened as a result of what I call a random day, where I would do 10 or 15 meetings with whoever wanted to meet with me. And one of those meetings on one of those random days was with David Cohen and him pitching me the idea for Techstars. So I'm very comfortable that, you don't really know what's going to come of something. And in the context of not really knowing what's going to come of something, putting yourself out there and engaging is very powerful. And it links to what's my personal philosophy, which I wrote about in the book Startup Communities, which is give before you get, and has been turned into a hashtag by Techstars. And the hashtag is give first. Somebody at Techstars realized that give before you get made for a pretty crummy hashtag. And this notion of give first is so important to me in terms of my own philosophy of life, which is I like to engage in things without knowing what I'm going to get back. It's not altruism. I expect to get something back, but I don't know when, from whom, over what time period, and what consideration, and what form, what magnitude. And so living a life where I put energy into the system that way continually has, what's come back to me unexpectedly in different ways in different places has far exceeded my expectations. So that's a piece. Like, that's my natural way of engaging. That doesn't mean that I say yes to everything and immediately respond to everything and do things. So the next is, the outreach from Shila happened, I don't remember exactly the day, but it was within a relatively short time after George Floyd was murdered. And in the context of that, that weekend, I had a very emotionally confused weekend. I was very upset and angry, but I was also very aware of my privilege and very aware of being safe and where I was and the resources that I had. And I had some internal struggle with my own understanding of how I was thinking about this and what I was doing or hadn't done around it. And Amy, my wife Amy Batchelor, and I, an example would be, we have always been very philanthropic around social justice issues. Our foundation, which is called the Anchor Point Foundation, probably, for 20 years we've been contributing philanthropically, but I recognized that I was providing money. I wasn't really engaging in solving the problem. I wasn't learning about things underneath the problem. I wasn't engaging around other people's lived experience. I wasn't really participating in eliminating racism. And I struggled with that. I struggled with that for the weekend until I landed on a mental model for myself of how to approach it, which is the same way I approached gender inequity. I grew up, my mother is a feminist. My parents were equal partners in their relationship. I grew up in a loving household, plenty of interesting issues that get resolved in therapy when you become an adult. But very safe and very supportive, solidly middle class, upper middle class in Dallas, Texas. My wife, Amy, and I are equal partners in our relationship, have been from the very beginning. And so as a man, I was very comfortable with the idea of equality with women. However, I'm in this industry, technology, where gender inequity has existed for a very long time. And more than just gender inequity, of course, with the Me Too movement and sort of a bringing to light of horrific behavior by men perpetrated against women in a gendered context. This weekend again of me sort of rolling around, why do I feel the way I feel, and how can I engage with this? It brought me back to 2005. And 2005 was when I really engaged with gender inequity in tech, and it was via a relationship with Lucy Sanders, who's the CEO of National Center for Women in Information Technology, or ncwit.org. And Lucy was introduced to me by a friend of ours, mutual friend, Terry Gold. And she was just starting this new organization called NCWIT. And she got together with me and she said, I want you to be involved. And I said, okay, tell me what it is. And she said, look, I'm starting this organization. I want to get more girls and women involved in computer science. And my big mission is that in the future, there's no difference between boys and girls and women and men in terms of their engagement in computer science. She says, it's not about gender equity. That's an outcome. She says it's about innovation. And she said, in the United States, if we don't do this, in 20 years, we will not be innovative anymore. If white men are making our products, and white men are running the companies, and white men are the engineers, 20 years from now, we will be in a world of hurt. And I want to change that. And I said, you had me at the word innovation. While the gender equity was appealing to me, the idea that gender equity was appealing, for me, that was the same mental model as eliminating racism. And so I could map to that. And so then I went back to my experience with NCWIT. And what I learned in the first 6 months of working with Lucy, I became the board chair of this brand new organization. I did that for many years. And I learned an enormous amount from Lucy. I hope she's gotten anywhere, fraction from me of what I've gotten from the experience with her. And what I learned within the first 6 months included things like virtually everything that I thought about the issues and the solutions were wrong.
Wow.
The anecdotes that were regularly bounced around were wrong. The white, mostly almost entirely white men, but men who continually showed up to fix the problem, at best were neutral and generally were negative to very hurtful to the system. The assertion of people who didn't have the lived experience of being a woman in tech had absolutely no understanding of how what they did and what they said impacted women in tech. And so within 6 months, it was very easy for me to become what today is known as and talked about as an advocate or an ally. And in women in tech, it was a male ally, male advocate. I didn't know that language. That language at NCWIT, I think we were one of the first organizations to really bring sort of advocacy and allyship in the context of tech and entrepreneurship to the fore. But it allowed me to change my complete mental model around this. And so, when I got the email from Sheila, I wasn't from a frame of reference of, I need to fix this problem. I was from a frame of reference of, what can I do to help people I know who are having the lived experience, so Black and brown investors, entrepreneurs, engineers, people in tech. What can I do to help support them with the 3 resources I've got?
Amazing.
Money, time, and influence. And influence is a proxy for network, right? Because I have a big network. I don't have access to their network, and their network doesn't have access to my network. And I think it's pretty easy. I learned very, very quickly, but I saw this with the same thing as gender and tech. Once you start linking those networks together as peers, once you start giving people access to each other, independent of what the structural dynamics are, things start to change very quickly.
Yes.
And, when I responded to Sheila, I don't remember the email thread exactly in my head, but she, again, it was an ask for books. And the books are easy. What else can I do with these resources that I have to help you with something you're doing? Not, I have this thing, or not, hey, Sheila, what should I do? Or can you spend time with me and tell me how to be better? That's not Sheila's burden, that's my problem. And so those are the things that cause me to engage. And you know, I've done that now, and you know, since George Floyd got murdered, Amy and I had a very conscious discussion that weekend about how to engage very rapidly with those three resources that we had under our control. And you know, we fortunately have a foundation that has plenty of money in it, and we made a decision about an allocation that we wanted to allocate across a bunch of organizations, not concentrate with one. Partly because while the money's useful, what's really long-term useful, I think, is that engagement across all of the boundaries and having people become part of my network, me being part of their network, them learning from me learning from them, totally different things, but having a long-term view of that. You know, I talk about NC Wood for 15 years. I mean, I'm still very involved in the effort to get more girls and women involved in computer science and entrepreneurship and investment. And you know, if you said, well, are you done with, you know, is that problem solved? The answer is, of course not. Right? Women are still in an extremely underrepresented category in tech, in entrepreneurship, as investors. Is it better than it was 15 years ago? Yes. Are there some structural inequities that have changed or have been broken down or eliminated? Yes. Are there some structural inequities that still exist? Oh, yes. And, you know, does that get fixed over time? Only if we maintain our attention on it, which I think is the last thing I want to say on this long rant, which is I wrote a blog post about our short attention spans. And my worry that with the issue of eliminating racism, our short attention span would kick in again, right? You know, Amy and I joke, crisis, 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 squirrel, right? Like a dog, right? Like, oops, oh, you know, where we can't, like as humans, the stimuli is such that we can't decide to actually stay on something. I'm really optimistic in this moment that our short attention spans won't kick in. But I know I'm committed to not having my short attention span kick in. So that sort of involvement is one that is appealing.
That's amazing.
That was a long answer to your first question.
No, I totally agree with you, because I think I and Sheila, we kind of discuss about it. I hope talking about diversity and backing Black female fund managers and Black founders is not a status quo. And I think this is what I wanted to ask Sheila also, that, you know, when you're looking these things around, how do you think that the program is trying to make the entrepreneurs capital ready? Because it is not just venture ready. You said that to me. And I think it's a long-term gain. That is what I think Brad is also saying, that I hope that this is a long-term gain to give the capital to this amazing founders. So what will this cohorts learn in this program? And how did you select planning to select the very first cohort in this program? And especially considering Beyonce has highlighted one of your startups.
I know, that was a nice one. So let me just back up a little bit. When I started in venture, of course, I started out sourcing a deal. Someone had brought a deal to my attention and wanted me to help source investors for them. So I said, sure, didn't know anything about venture, but you know, I'll dig in. I'm really good at connecting. That's my sweet spot. So, but during that time while sourcing for investors, I also was starting to advise and mentor some startup companies. And, you know, having these conversations and learning just enough about venture, you know, I felt like a lot of these companies were not ready. Yes. And why would I sort of expose them to, you know, talking to a venture capital or angel investor when in actuality they need to work on some things in their business, right? And so once we got the fund started and started thinking about programming, so we did things backwards, right? We built the ecosystem and then the fund. So we had already started having events and bringing resources to startup companies in their own backyard. We call it the roadmap forums. And so we decided that we would create a program for, you know, the entrepreneurs in our community, not so much our portfolio companies or potential portfolio companies, but the entire diverse entrepreneurial community.
Wow.
And so they go through a 12-week program with deep functional experts around a particular topic such as go-to-market strategy, financial planning and forecasting, sales and accelerating traction, and mainly how to close the deal. And this is where we bring in different types of capital sources to talk about how you close a deal with them. So we'll have angel investors, crowdfunding, someone who has an alternative investing model, so it's not just about venture, because I think there's this sort of sexiness around venture. So everyone who has an idea thinks, oh, I'm going to go get venture capital. And it's like, back up a little bit. There are some things that are required for venture. And so I wanted to make sure at least the community that I'm serving were capital ready when they began to talk to investors, not just venture, but any source of capital.
That's
and
great.
So that was the thought behind why we created this.
That's amazing. And your daughter, Zane, after whom the fund has been named, was an innocent victim in gun violence, and she survived such horrific incidents. What inspiration you drew upon such a life-threatening incident to further your capital deployment mission at such a grassroots level to build generational wealth for underrepresented minority entrepreneurs?
Sure. So, of course, I'm in Atlanta, and that particular moment, I was actually helping source investors. Well, we were actually waiting for the deal to close. We did a letter of intent and that sort of thing when this incident happened. And it happened right where, I know you guys have heard of the murder here that happened at Wendy's. Roderick, I can't think of his last name right now, in that same area. And I'll be honest, I lived in the suburbs, so I didn't travel through neighborhoods a lot here in Atlanta. But doing my research after that happened, I found that this was one of the worst. That neighborhood was one of the most crime-riddled neighborhood. It was like number 26 in the entire country. And so I looked around me and I saw what I considered to be venture redlining. No one had did anything in terms of substance to be able to help this community overcome its economic barriers. And so I started thinking about, where it happened, who I had been serving, the work that I'm currently doing, which was around entrepreneurship and helping startups get, access to resources. And I would start my own fund to solve this, because I understand how in a city as rich as Atlanta, we have a lot of wealth here, that a neighborhood sitting right on the other side of the highway could be just as venture redlined. And so I said, I'm going to do something about it. I'm going to look to invest in companies who are out solving problems, right? Who are creating innovative solutions. And that way we can not only solve the gap for venture capital, but we can solve the wealth gap as well. So communities don't have to be like this in this day and age. And there's so much technology and innovation and actual capital in the market to solve this. And so that's the inspiration I drew on. She was the one who told me to continue the work, because I thought, I'm not going to do this anymore. I've worked 25 something years in communities. How am I now a victim of crime in a community that I've often served? But my daughter made me flip it to the other side, that you could be the catalyst of change for this. Your work could be the one that determines how, entrepreneurs, diverse entrepreneurs now have an access or a path by the work that you're doing. So that was the inspiration I started drawing for my daughter. Which is why the fund is named after her, because she was the strongest person, even though she was a victim of violence. She was the strongest person to stand up and tell me, Mom, go ahead and do this. And so that's why we're here almost 2 years later. Yeah.
That's amazing. I think when you're starting your ZANE fund, there's so many emerging fund managers that are in this space. I would love to know Brad's take on this, because there's so many micro funds and pre-seed funds are becoming institutional asset classes now. Can you tell us about the new market opportunities for emerging fund managers like us? How has the market changed in the last few years?
Well, I think there's been a steady change that then incorporates a phrase called a phase shift, which is part of the notion of complex systems and how complex systems work. And I'm spending a lot of time talking about complex systems right now because of a new book I have coming out called The Startup Community Way. And the whole notion of building and evolving startup communities is built on this notion of how complex systems work. And I think it's very important to understand in this moment, because in 2007, when venture capital was still very out of favor, and Web 2.0 was kind of starting to become a thing, that's when we started Foundry Group, and we started Techstars in 2006. So we started them both in an environment that was not a very vibrant environment for technology and innovation and investment. And then we ran right into the teeth in 2008, 9, and 10 of the global financial crisis. And the global financial crisis was completely unexpected from the frame of reference, not just of entrepreneurship, but I think of many people were caught by surprise, independent of what people say in hindsight. And it was a very challenging moment in time structurally for global economies. But as investors and entrepreneurs, especially with a new fund with Foundry Group and that was considered an emerging manager, and Techstars, which was a completely new kind of thing in the notion of accelerators not really being a thing yet. We really didn't pay much attention to that global macro. Because innovation and entrepreneurship and new company creation is decoupled in a lot of ways from the macro dynamics. That doesn't mean that they aren't influenced by that, but they're decoupled. And there's a cliche, endless cliche in investing in venture capital. Some of the greatest companies were started in some of the worst economic times. And the cliche is a good cliche, it's a relevant cliche, but more importantly is this notion of things being decoupled. I mean, entrepreneurs create something where nothing existed before. Emerging fund managers are creating a new fund where something didn't exist before. This is just hard.
Yeah.
And the interesting phase shift that we had, and I think it probably took place around 2015 or 16, was the shift from the idea that this was an exception to the idea that this was something that could be achievable by many, that it wasn't the domain of exclusivity and exclusiveness, but was an interesting thing that was a fundamental engine of entrepreneurship, not just in Silicon Valley, but anywhere in the world. And obviously the idea of startup communities developing and growing anywhere comes from lots of history, but my first book about startup communities in 2012, named Startup Communities, made that assertion back when people were still saying, oh, if you want to build a tech company, you really should just go to the Bay Area.
Yeah.
I think in 2020, in this moment, what we're saying, I think what's being, I don't say we are saying, what's asserted and what all assert is that the democratization of this is now cutting across gender and racial boundaries. And there's a recognition and understanding, at least by some set of people around the industry, both on the investing side and the company creation side, that the biases that white male investors and white male entrepreneurs and white male-centric networks have are inhibiting. And that the idea that that's the model is extraordinarily short-sighted, especially over a longer arc, independent of the inequity that it creates and reinforces. And so at many, many levels, I think we're in a phase shift, which, by the way, phase shifts happen suddenly.
Yeah.
But then it's not that you have done this phase shift and then everything's great. It's that then you have a bunch of work in front of you. And I think we're at that point with the phase shift where the phase shift has happened. So we have the opportunity to view it differently. But now there's a bunch of work in front of a bunch of different people. And, I'm just incredibly happy and honored to be able to be supportive and involved with people like Shila and many others that I've gotten to know, and you, in being involved in what's going on and being able to participate, which is another part of the phase shift, which is, I think, as you have a generation of investors and entrepreneurs who, if one looks around at the world and said, over the last, pick your time frame, did the baby boomers make the world a better place? Is the world a better place today than it was? I'm a Gen Xer, so I'm one of the original slackers. I was born right on the boundary. Thank God I'm a Gen X and not a boomer, so that at least I can criticize the boomers as much as I want. But as a slacker, nobody expected anything of me. And, is the world a better place than when I was in college? And on some dimensions, sure. But on many dimensions, not at all. And maybe even a worse place. And so, like, in this moment, it feels very important to acknowledge that as a starting point versus saying, oh, no, it's better. It's better for everybody except for these people. And for those people, it's better for me. Like, all right, good for you, it's better for you. But why does that mean it's better? And I feel like we're in a mode where at least that conversation can happen again. By the way, especially in the United States, after the last couple of years of that conversation being an incredibly argumentative one, partly because of politics. My view is COVID is a pretty big normalizer of that. It is a very, very scary and uncomfortable thing that does not choose you based on the color of your skin or choose you based on your gender, regardless of whether you deny that or accept that. And I'll just reflect. Am I proud as an American of the American response collectively to COVID? Not very much. By the way, I'm pretty proud as a Coloradan. Like, I think within Colorado, we've done a reasonably good job. And I attribute a lot of that to the leadership of our governor, Jared Polis, and the way that the private sector and the public sector have worked together. But if you scale it up to the whole country, like, is this a moment where as Americans, we should be proud? I mean, last time I checked, I think we're the worst in the world at handling this.
Yes.
And, oh, by the way, it's not just a health crisis, right? It's a health crisis that perpetuates economic crisis and economic inequality, which generates a mental health crisis because we're not used to being in our house 24 hours a day, 7 days a week, and the financial pressures that some people have and the increase in inequity between people on a global scale. And of course, in the middle of this, we have a racial inequity crisis, which, by the way, has been going on for 450 years or more. And then here's an amplification of it. So I give that as a backdrop to the phase shift. Like, I think all of these things colliding in this moment are creating a great opportunity for the next wave of emerging managers, but it doesn't just happen. And it doesn't just be successful. There's going to be lots of things that work and lots of things that don't work. And, it's one of the things in the conversations, interactions I've had with Shila already. There's good understanding of that. There's rapid learning, rapid iteration, trying different things, not believing, well, this is how it should work, or anything like that. It's I want to learn and I want to figure this out and I want to make this happen, and that's what's going to cause there to be real success.
So well said. And I think what you said is so true. I think the emerging fund managers are also like entrepreneurs. They're struggling. They're also scrappy. They're trying to raise their fund. And I would like to ask this question to Shila, because recently when I was talking to Lo Tony, who's the founder of Flexo Capital, I spoke with Arlen Hamilton, who came to SheVC, and a couple of other very well-known Black female fund managers. And we are trying to understand how many female Black fund managers have closed their fund successfully in the last decade. And we were struggling to even name 10. So right now we are living in an economic civil rights movement. That's what you said. And do you see that there's a change, how the new market opportunities are coming, especially for emerging Black fund managers?
So when I made that statement, I was really referring to how companies, big companies, corporations were throwing money at individuals when it was almost as if, well, couldn't we have done this years ago, right? Couldn't we have, even though money is not going to solve all the problems, right? There's definitely some shifts that we need to make across this country. But so I was saying that because it seems like when folks have asked for sort of, assistance, not charity, corporations weren't ready to sort of get involved. A moment like this, people are $100 million, it would seem like nothing for folks to say, hey, we're going to give it to this organization and we're going to support that organization. And so those are the sort of the reasons why I was calling it an economic civil rights movement at that particular time. I think it's shifted in the last few weeks because, and I'll give you an example. So there was an article in Bloomberg yesterday. There's a fund that they did their initial close for $15 million led by, I think, 2 Black guys. So the headline in Bloomberg was investing in VC fund for diverse fund founders is getting competitive. And so that made it, yeah, and we had a whole chat. I don't know if you're in that Slack group about
Yes,
that.
you're.
It's a signal to the market that there's so many of us, right, that there's not going to be enough to be funded. And I think that's unfair. My thesis is differentiated from a whole lot of other folks. We just happen to all be of a certain race and gender. You know, so I don't like, there are some women I don't understand why their funds haven't closed. They definitely come to the table, you know, with everything that's needed. You know, for me, investing is not my wheelhouse, but I brought a strong partner with me. I know what I don't know. And not only my strong partner, but I surround myself with people, again, that to be able to share with me what I don't know. So I don't you know, for me, it's kind of hard to understand why some of these folks have not gotten funded, you know, or some had to close on a very small amount to do their work, you know, but that's a shift that we're going to have to change. You know, there's very smart people out here who have founders that, you know, like for us, I've only been in this for a short period of time. We have a database of founders of it's over 1,000 now. And that's just by me connecting with them through my events, through our programs, that sort of stuff. So, you know, we have access to the deal flow. You know, even through other things outside of our own communities, there is deal flow available, right? And so I'm not sure how we're going to get to that point. I'm not an expert on why these folks haven't closed their funds. But I think it's definitely something that we should be paying attention to and not saying that it's starting to get competitive. You know, that just sends the wrong signal to me. And I just want to say this too, you know, we're not looking for charity on our end. This is not feel good money. This is high growth investment. This is actually looking for great returns for the LPs who come and support, you know, sign on with us. And so we want to say that we're looking at great deals. This is not looking for, you know, something that's just going to be mom and pop. We're looking for our companies to scale just like any other company. So I just, you know, for me, it's like, and Brad said this earlier about the attention span, and I've said it a few times that I don't think it's a pipeline problem. I think it's an attention problem. What are you paying attention to? Whatever you're paying attention to the most, that's what you're going to continue to pay attention to. But if you decide to look beyond that or the norm, and start looking at some of these other types of funds or entrepreneurs, you know, and seeing how they are sort of de-risking some of the things for LPs before they even got the LP funding, I think they will find that, you know, there are a breadth of opportunities out there, you know, and I'm not just speaking for my fund. I speak to women all day long, every day about their funds. And so, you know, I'm not sure. I don't have an answer for that. I can't tell you why they're not. I'm on the other side of the table. I'm right there with them, assuming to have a fund close as well.
So well said. I mean, I would love to know Brad's take on this, because do you think there's a kind of shift in mental model and investment thesis, especially on the LP side, is required to close this wealth gap in capital deployment?
A couple comments. One is I think the Bloomberg article title is stupid. And I think most headlines of media these days is literally clickbait. I literally think that the headlines are clickbait, and you know, the goal is headline gets you to click. And the problem is, again, short attention spans. People don't read the article. People read the headline, or you know, people, it's behind a paywall, so all they can read is the headline because they don't have a subscription. And so I'll just start with that. Like I think that's a stupid article headline. Next, venture is a long game, and you know, an emerging fund manager, somebody creating a new fund, is an entrepreneur. That is fundamentally an entrepreneurial endeavor. Right. And there's lots of different approaches early on, but historically, many people who started new funds, they actually had resources to be able to start the new funds from whatever they had done. And that's a challenge for many new fund managers. And the resources, not just money, but also track record, experience investing, that sort of thing, that is not always clearly understood what is important and how to think about it and what you can do. And it creates additional structural inequities, right? If you think about, you know, we use the phrase wealth gap, right, between potential, I heard this on a podcast yesterday. I'll use the analogy, but I'm going to forget the exact specifics. I think Brian Hollins was one saying it.
Yeah.
If I go to college and my dad's worth $1 million, my parents are worth $1 million. I can leave college and I can screw around and try to start a company for 2 years because I know that dad's going to pay the rent and everything's going to be okay. If my family has $100, I can't do that.
Right.
The opportunity's gone. Like I have to go make money. I have to, I don't have the ability to sort of screw around for 2 years and maybe something good comes of it. Just understanding that as a starting point, understanding sort of the networks as a starting point and what sort of how to think about it is, I think, part of the structural inequity of this against the backdrop, and I'll come back to it, even the person who has the resources, they're still starting up a new thing that's very hard to do and very hard to have success with. And by the way, for seed stage investors, you generally don't know if you're successful for 5 to 10 years, right? It'll take you a while. Like every now and then somebody has a big success early on in 2 or 3 years, but it usually takes a long time before things start, the companies that you're investing in start to be successful.
True.
So the whole process is time intensive and has to unfold over a period of time. And for a new manager, like understanding that is fundamental. And then for LPs, it's not an investment in a moment in one thing. It's an investment in that team or those GPs or those fund managers. And most institutional LPs, when they make a commitment to a fund, they're committing to at least 2, probably 3 funds, because they know that Fund 2 is going to be raised before you have any evidence that Fund 1 is working. Probably the only thing you'll know is whether or not the partnership blew up. But you're not going to know if the investments are any good or not, so you're committing for 2 funds. And a lot of times you're kind of committing for 3 funds because you might even get into year 5, 6, or 7, and you're not totally sure, like you've built a relationship and you have confidence, but the returns aren't necessarily there yet. And if you stop supporting that fund manager, interestingly, that has a second order negative effect. That's different, by the way, than individual high net worth investment into the emerging manager set, because a lot of high net worth invest into one fund, or they invest when they feel like they're high net worth, and then if something happens and they feel less high net worth, I'm not going to do venture funds anymore, or I got too much money in venture funds, right? So you've got all of these dynamics that are going on behind the scenes around the investment in the fund managers, decoupled from the structural inequities. But those things reflect off each other. And I think that makes it that much harder for women to raise money, and now for Black fund managers to raise money. And the institutional LP dynamic and the reaction, and I think it's actually a helpful thing, but it's an in-the-moment reaction, is to allocate money to diverse managers or teams that have at least a diverse partner in it. That's a good thing, right? Because it generates more flow of capital. But if it's a zero-sum game, I only have X amount and I can only do this many, that, to Sheila's point, starts to be inhibiting. Now, should every investor invest in every fund that has a Black manager? Of course not. And by the way, every investor doesn't invest in my fund. I have a whole bunch of people who say no to me. And some of them may wish they hadn't, and some of them may be happy that they did. Like, who knows?
So people are still saying no to you.
Oh yeah, of course. And that's yes. And every time a company goes out and raises money, even if the company's successful, some successful companies everybody wants to throw money into, but the vast majority of them, it's not a yes from everybody. It's lots of yeses, or lots of no's and some yeses, and that's a process. So I think just understanding that over a spectrum and then putting time on the x-axis. And the more time and luxury you have to play it out, the higher the probability of a positive outcome. And that's where some of the structural inequities come in, that we've got to do something to change in the near term so that they don't play out in the long term.
Right.
Very, very well said. I think Brad mentioned that point, and it stuck to me, the opportunity cost, that if you're grown in a certain, with a financial wealth or family, you have that opportunity cost to play around, So these early stage founders, Sheila, that you are investing or you are giving them access in your pre-capital access program, how are you creating those risk profile adjustment when you're selecting your first cohort, especially in this time?
Our cohort are not our portfolio companies, right? So these are two separate things, right? So ZANE Access is our programmatic arm. ZANE Venture Fund, of course, is a fund. And so what we're doing is solving not for our companies, the companies we intend to invest in, but for the entrepreneur community as a whole, right? So that and it's still the same sort of thesis, diverse entrepreneurs here in the Southeast and across the country. In terms of what the biggest thing is that we're looking for innovation, right? So these companies how are they innovating around a particular, whatever the company is, right? And so that's the difference, but they're not our portfolio companies. These are companies that just are coming through on the ZANE Access side. Right now, we have talked about reserving capital for some companies that come through that are very, sort of interesting to us and that we want to invest in, right? But the goal is to get companies capital ready for whatever source of capital that they intend to.
That's good. I mean, especially in this, the period of uncertainty, you'll find some of this entrepreneurs that you're looking to educate through the capital access program. Many of them are not venture ready. And I like what you said. Many of them are small businesses, and venture capitalists, it's a very different field. It's a very fast field. And in a time like this, I would love to ask Brad, because private companies tend to have have a far less short-term volatility compared to publicly traded companies, which are subjected to rapid price changes from the market forces that may not reflect their underlying company fundamentals. And that's what we saw in Amazon for many years. Amazon shares were not doing that great, and suddenly, boom. So as more companies, they tend to stay private, especially right now in this environment. Do you see the exit environment will look quite different than what it is now or than it was in the last few years?
It's an unanswerable question from my perspective, and let me give some context around that. I'm very careful, consciously, not to be a predictor, because I don't actually think it's helpful. In the venture world, there's lots of people who are predictors, and there's lots of people who are prognosticators, and in business there's lots of people who are predictors and prognosticators, and there's plenty of vehicles for getting that kind of stuff. Almost by definition, it's wrong. And when it's right, it's usually not right because the predictor had a true understanding of why it was going to be right. Sometimes it's just guesswork and luck, and sometimes it's a relatively obvious thing. But most of the time, it's a function of so many things that are interacting with each other that it's very, very hard to have any certainty. One of the cliches I love that I've been hearing since I first started investing in the mid-90s in startups was, whenever you're presented with a plan, there's one thing you know: it's wrong. Whatever the financial plan is, whatever the projections, can I see your 3-year, can I see your 5-year projections? I know with certainty one thing about your projections, and that they're wrong.
Yep.
And so I kind of have the same view of that kind of a question. It's nothing wrong with the question. My answer is, I don't know. And, it's one of those things where the interactive effects of all of these different things in a complex system are going to change stuff over time. And, a word I like better than, I'd rather than be right about my predictions, I'd rather have resilience. I'd rather be able to learn through the ups and downs, right? I'd rather have some non-attachment to the specific outcome, non-attachment being deliberately chosen. If you're attached to the outcome, I really, really want it to do this, and when it doesn't do this, I'm devastated. That's attachment. Non-attachment is, I don't give a shit. Whatever happens, happens. They're the same thing. They're just the opposite sides of the coin, but they're the same thing. Like you have this need for a thing to behave a certain way. Non-attachment is the thing's going to behave how it behaves. You care about it. You want to interact with it. You probably have lots of ideas about how it should or how you want it to behave, but you can't control what is going to happen. And so if you try to control what's going to happen, you immediately go to one of those two poles. And look, if you really, really want something to happen and that happens, you feel good. Until the next time you really want something to happen and then that doesn't happen and then you feel bad. And in entrepreneurship, lots of shit doesn't work. Way more things will fail than will succeed. And by the way, and Sheila probably knows this well, as an investor, you will probably have many more failed investments than successful investments. The failed investments, you can only lose your money one time.
Right.
The successful investments, you can make your money hundreds of times. So you don't need to have the same, you don't have to have one more success than failure. You just have to have the successes be equal up in magnitude greater than the total number of failures that you have. And like when you can change your frame of reference to that, the failures then become opportunities to learn, grow, develop, figure out new things, apply to the next thing you're going to do, versus this thing that, causes you incredible angst and unhappiness and dissatisfaction. And so back to the predictions, like, would it be nice if there was an awesome public market? I mean, having been in and out of public markets for a long time, as a private market investor who depends on public markets for one of the sources of liquidity for the companies I make, what's very clear to me is that the public markets are open, they close, they open, they close. Sometimes they're up, sometimes they're down. I can't do anything about it. So rather than try to do anything about it, I'm going to focus all my energy on trying to help the companies I'm an investor in become long-term, durable, successful companies, and the outcomes will happen.
I like what you said, especially, timing a market is almost a fool's errand, and you're actually building a fragile company or a fund if you're betting on certainty. So,
Sure.
I mean, you talked a lot about, recycling, management fees. So I would definitely like to talk to you a little bit about that, because right now, the time that we are living in right now, what do you think? Like, we know that by recycling GPs, management fees are extending the capital pool to deploy. So what's your thought, especially for many family offices, and not many institutional LPs, but they are like, oh, I want to have a strong liquidity option. I'm okay to get out of the fund after a few years, but but that may not be giving a great return for them.
Yeah, recycling is, in some ways, it's a really simple concept, and in others, it's very difficult. And it also has characteristics that change depending on the size and scale of the fund.
Yeah.
And then the last is it has a lot to do with the vagaries of the cash flow and the resources that you have. If you're in a position as a GP where you have resources, it's much easier to recycle than if you're in a position where as a GP you don't have resources. Generally speaking, institutional LPs immediately understand the economic leverage that comes from recycling. High net worth, the sophisticated ones in venture do, but many of them don't, because they're much more focused on the absolute returns and the time to the dollars back than they are on the compounding impact of recycling. And for people who don't understand or don't know what we're talking about with recycling, it's a very simple, I'll give a very simple explanation, which is if you have a $100 million fund, over the life of the fund, roughly 15% of the fund is going to get paid out in your management fee. It could be plus or minus a little, but roughly that number. So of the $100 million, only 85 million gets invested in companies. And what recycling is, and you're allowed to invest 100 million. So what recycling is as you have returns, instead of distributing the returns back to your LPs, you reinvest those returns to try to generate more returns. And Recycling 100% means that if I'm an LP and I give you $1 and you recycle to 100%, you have invested $1. You're still taking out your management fee, but you're using the returns to get that full dollar invested. Interestingly, lots of funds recycle above 100%. Most of our funds are 105 to 110% recycle. The reason that LPs like that is that they're getting the full dollar to work. If they believe in you as an investor, instead of only getting 85 cents or $85 million to work, it's 100 or 110. If you multiply that by 3, your returns become higher downstream, right? Yeah. Second, they don't pay an extra fee on the recycling. So the recycling is essentially fee-free money. So it's a better sort of leverage investment. And frankly, for me as a GP, if I believe that I can get the returns on that capital, I should be willing to continue to reinvest that capital. Now, there's a bunch of constraints. One of them is whether or not the GP has the resources to be able to deal with the recycling. Cash flow is an issue, right? Because you can't predict when you're going to get your returns. So if you take your management fees, but you reserve as though you're going to recycle at 100%, but then you don't have any returns to recycle, you might have a $15 million gap. And if you have $15 million, well, you can loan the fund your own money and pay it back. But if you don't have the $15 million, what do you do? And there's other approaches to dealing with it, but there's a bunch of nuances. I am a big proponent of recycling. And I am a big proponent of another concept that's in the Startup Community Way book called entrepreneurial recycling, which is that when entrepreneurs in a startup community generate wealth, if they care about the place they're in, they love their city and they want it to be successful, one of the most powerful things they can do is take some of the wealth that they made from their investment or from their company and reinvest it in other entrepreneurs in their community and take the risk where those other entrepreneurs might or might not be successful. And then, by the way, not just their money, but their time and their experience and their network. So this notion of recycling is a powerful one because you can get a compounding value over time, even with failures in the mix. In the absence of recycling, you don't get the benefit of that compounding leverage.
Well said. I would like to ask my last question to both of you. So Sheila, I would love to know what's the future of the ZANE Pre-Capital Access Program? I know you just started, but where do you see yourself, this program blooming, and what's next?
So we're definitely going to be doing it again. We're getting a lot of anecdotal feedback from both sides, not only the coaches, but also the cohort. And so we feel like the program design is great. There may be some things we need to tweak, but we definitely want to continue doing these. We're probably going to do 2 a year. We're trying to decide how many per year we would want to do and how we would sort of do it continually in a virtual environment, because initially this was supposed to be face-to-face. And so, so we feel really good about it in terms of not only like the companies that have come through, and of course the Beyonce sort of shout out gave us even more attention to our program and what we're doing. So we are definitely going to continue doing it, and hopefully we still have partners like Brad on board who are willing to help support. Anyway, not only money. My point is that sometimes entrepreneurs don't need a check; they need some actual resources, right? They need somebody to be able to help them, shape their companies to success. And so, so we feel like, yes, it was sort of our inaugural one, but it has gone very well so far. And we're very proud of that. And Brad is going to be at our graduation, so we're excited about that as well.
Wow, that's great.
Sheila, I'll publicly commit to support the next cohort the same way I supported this cohort. I think what you're doing is great. So it's on tape. I'll commit the same books, the same dollars, the same time.
Oh, thank you so much, Brad. We appreciate that. We so appreciate that.
That's huge.
You can put that in the bank.
Okay, thank you so much. We appreciate that.
This is amazing. And so my last question to Brad is that you talked about philanthropy, and we are seeing it right now. You focused on entrepreneurs and education and intersection of things like way back, when it was not a thing or a status quo. And I was reading one of the Denver's posts, you and Amy, your wife, you said, and I quote, "We decided we were going to give away all our money while we are still alive." you talked about how Techstars Foundation and your own foundation are focusing on improving diversity in entrepreneurs. So what's the legacy of Brad Feld as an investor, philanthropist, catalyst of change?
So I love the word legacy because I have regularly said that I don't care about my legacy. And I have people that try to convince me why that's a statement that isn't helpful. And my response is mostly that they're misinterpreting what I'm saying. Amy and I don't have any kids. We decided purposefully not to have kids. I believe that when I die, it's over. And so I want to have the full experience while I'm alive. And because I don't have kids, it's very easy for Amy and I to view our money as a resource. And we've been successful. I have a comfortable life. I don't need any more new this, that, or the other thing. And so it's very easy. And by the way, I still am accumulating more wealth because of all the different things. Again, it's a long-term arc, and I have a lot of investments and a lot of things that have been deployed over the years that, continue to, many things don't work, but the things that do work continue to have economic return. And from the beginning of my relationship with Amy 30 years ago, she introduced me to the idea of philanthropy. And the first year that we were together, I think we gave $25, not $2,500 or $25,000, but $25 to Wellesley College, where she went to school, to the Mass AIDS Project, because we were in college during HIV and AIDS, and we're very exposed. Exposed is not a good word with HIV, I suppose, but involved. Amy's previous boyfriend to me was a hemophiliac and was HIV positive. Unfortunately, he's still alive. And but it was a thing that we were aware of. So the Mass AIDS Project was very interesting. And then I think we gave a little bit of money to the Nature Conservancy, which to this day, Amy's on their global board, and we're still very involved in them. But from the beginning of our relationship, we collectively derived a lot of enjoyment, satisfaction, learning, and experience from being involved in other organizations philanthropically with, again, the things we have developed over time, money, and influence. And it's just wired into the way we are. And so I don't care about legacy because I'll be dead. And I want to have the lived experience, whatever mine is, the ups and the downs, as fully as I can. And part of that is using one of these resources that we've developed, a la money, of which we have, fortunately, an excess for than we need to live our daily lives, to be involved in and influence and create change and support things that we want to see improved from our frame of reference in the world. I'll just end with, I think philanthropy is extremely selfish in the most positive way of the word, which is that it's a decision that Amy and I are making about what to do with our money to support things that we want, to help create change that we want while we're alive on this planet. That in some ways that's a pretty selfish statement. If you took all the nice words out of it and said, well, I just want, things to go the way I want them to go, and, to make the planet better the way I want the planet, that's a pretty selfish statement, right? So I view it as a positive version of it. And hopefully, the things that we're choosing to engage in are generally forces of good instead of forces of bad. But that's how I think about it, and that's how I think about legacy, which is it's much more interesting to me to participate today, both the good and the bad, to navigate through and work through this experience we call life. And I understand, for example, that it's different if you have kids. I understand that, and so I recognize that we're in a different position than many around that idea. But that was also a function of a deliberate choice.
That's great. Thanks a lot to both of you. And I think I'm looking forward to the impact that both of you are creating, especially in underrepresented founders and fund managers.
Thank you. Thank you. This is great. Thank you for having me.
Thank you for having both of us, and thank you, Sheila. Good to see you again, and
Same here, Brad.
and enjoying every interaction and every moment of things that we're doing together. So thank you for letting me be part of it.
Oh, of
That's
course.
great.
Of course. Thank you so much, Brad, and thank you for your commitment to Zane for our next program. I really appreciate that.
Totally.
Amazing.